Today, we will talk about gross rate of return. The gross rate of return is the total rate of return on an investment before any fees, commissions, or expenses are deducted. It's quoted over a specific period of time, such as a month, quarter, or year. This is different from the net rate of return, which takes fees and costs into account for a more realistic measurement of return. The gross rate of return on an investment is one way to measure the gross profit of a project or investment. It includes capital gains and any income received from the investment. On the other hand, the net rate of return deducts fees and expenses from the investment's final value. The formula for gross rate of return is gross rate of return equals /initial value. Details on how an investment company calculates returns are often included in the fund's prospectus. The gross rate of return is usually what's quoted in fund marketing materials, especially for returns longer than a year, which are often annualized. The CFA Institute's Global Investment Performance Standards govern the calculation and reporting of returns in investment management, providing a standard for comparing investment return characteristics across the industry. Return calculations are often used when considering a new investment or assessing the performance of an investment. Investors often use the expense ratio, a mutual fund characteristic showing the percentage of fund assets paid for expenses, to determine how expenses affect the fund's return. For example, a large-cap fund like the quantified STF fund reports a gross rate of return as well as a breakdown of expenses. It has an expense ratio of 1.71%. For net return, fees, commissions, taxes, and inflation are deducted. Inflation affects an investment's return because it causes the currency to lose purchasing power. So, it's important to include inflation in the calculation of real return. The gross rate of return can be significantly different from the net rate of return, which deducts fees and expenses. For example, a mutual fund that charges a 5.75% sales charge will have a very different gross return than the net return after the charge has been deducted. Here are 4 key takeaways. 1. A gross rate of return is reflective of an investment's return before expenses or any deductions. 2. A net rate of return is the investment's return after costs, such as taxes, inflation, and other fees. 3. The net rate of return is often more difficult to precisely calculate than the gross rate of return, so a fund's expense ratio is often considered in weighing the return value of the fund. 4. The Global Investment Performance Standards allows investors to compare the return characteristics of different funds. Hope this would help. Thanks for watching.